On January 23, 2025, a single signature sliced across a presidential document. Quiet, ceremonial, almost routine. Yet in that moment, the global monetary order cracked open. President Donald J. Trump had just authorized the creation of a U.S. strategic Bitcoin reserve. The headlines glowed with celebration. Cable news called it a pro-crypto breakthrough. Wall Street rang the bells. Bitcoin detonated upward, briefly touching $100,000. And the internet crowned it the beginning of a digital renaissance. But beneath the applause was a silence only nations understood. Because this executive order was not about innovation, and it was not about crypto. It was about power. More precisely, it was the opening shot of a currency war, a slow-burning conflict over who will command the future of money. And on the other side of the world, China understood it instantly. Within 72 hours, before the American public even absorbed what had happened, an emergency gathering of China's most powerful political body was underway. The Politburo Standing Committee, 7 men who, together, steer the destiny of 1.4 billion citizens and wield influence over the world's second-largest economy. They did not meet to discuss Taiwan. They did not meet to discuss trade, military disputes, or technology. They met to discuss Bitcoin. Because in Beijing's eyes, Trump's executive order was not domestic policy at all. It was a strategic escalation, a pivot in the global struggle for monetary supremacy, a declaration that the United States intended to weaponize Bitcoin, just as it weaponized the dollar throughout the late 20th and early 21st centuries. China saw it for what it was, not a memo, a warning. And warnings demand responses, not in speeches, but in machinery, capital, and state power. Right now, China is preparing a counterattack that few in the West even suspect. A mobilization so vast it will rearrange global markets, redraw alliances, and determine which nation, America or China, will anchor the monetary future. Today, we trace that response, the hidden countermeasures, the economic psychology, the long-game strategy that China has mastered across centuries of dynastic competition. Because this isn't theoretical. This isn't prophecy. It has already begun. Context. Why Bitcoin? Why now? To understand why China interpreted Trump's order as an act of aggression, you must first understand something most people overlook. Bitcoin is not just a technology. Bitcoin is geopolitics. It is the first monetary asset in human history that is neutral, borderless, unforgeable, outside any single nation's command. No empire can print it. No central bank can distort it. No army can seize it, if secured properly. It is, in many ways, the closest humanity has come to digital gold. But with one radical twist: gold lives in vaults controlled by governments. Bitcoin lives everywhere and nowhere. For 75 years, the United States has dominated global finance through control of the US dollar, the world's reserve currency since the end of World War II. Nearly 70% of international trade settles in dollars. Roughly 60% of global central bank reserves are dollars. Nations rely on dollar-based systems for banking, liquidity, and trade. This structure gave Washington unparalleled leverage, the ability to reward allies, punish adversaries, and steer the global economy through the sheer gravitational pull of its currency. When America dislikes a nation, it freezes its dollar reserves. cuts off access to SWIFT, weaponizes sanctions, and cripples economies without firing a bullet. Iran, Russia, Venezuela, Afghanistan. The list grows with each decade. And each time the US uses this financial weaponry, rival nations are reminded their monetary lifelines depend on the goodwill of Washington. So for years, the world searched for alternatives. China tried to internationalize the yuan. Russia pushed for bilateral trade in rubles. BRICS floated dreams of a shared currency. But none of it worked, because nobody trusts centralized currencies controlled by authoritarian states. China manipulates the yuan. Russia capital controls the ruble. Smaller economies suffer credibility problems. The dollar remained dominant not because America was perfect, but because every alternative was worse. Until Bitcoin. Bitcoin offered what no state could offer: trust without a government, neutrality without negotiation, scarcity without manipulation. To China, Bitcoin represented a narrow corridor to escape the dollar's shadow, a corridor they believed America would eventually try to block. And on January 23, 2025, China believed the blockade had begun. Pattern reveal. Why China interpreted it as war. Trump's executive orders signaled something radical. The US is moving to accumulate Bitcoin at a nation-state scale. If America secures enough Bitcoin, hundreds of thousands of coins, maybe 1 million, then Bitcoin no longer becomes a neutral asset. It becomes an American strategic reserve, another tool in Washington's financial arsenal, a digital extension of dollar hegemony. To China, this is the nightmare scenario. They fail to internationalize the yuan. They fail to erode the dollar dominance. And now Bitcoin, their potential escape hatch, becomes Americanized. In this future, China loses twice: the existing system and the replacement system. No great power accepts that outcome. Not Rome, not Britain, not America, and certainly not China. Trump's order forced Beijing to act, not out of opportunism, but out of survival. China must compete for Bitcoin accumulation. They must prevent an American monopoly at all costs, even if it means bending their own policies, reversing previous bans, and mobilizing their entire economic machine. Because in the 21st century, currency is power, and scarcity is sovereignty. Just as the Cold War was fought over nuclear arms, this century will be fought over digital reserves, Bitcoin foremost among them. This was the beginning of the new arms race, and Beijing was already drawing their battle lines.
Modern parallel, a mirror of the 20th century. We've seen this dynamic before. In the 1940s, the United States secured global dominance not through weaponry alone, but by architecting the Bretton Woods system, a monetary arrangement that crowned the dollar as the centerpiece of world finance. Today, the world stands at a similar crossroads: a declining superpower seeking to preserve its dominance, a rising superpower seeking to rewrite the rules, and a new monetary technology disrupting both. Bitcoin is the modern counterpart to the gold standard debates of the 20th century, a neutral anchor around which nations might reorganize global trade. In 1971, Nixon abandoned the gold peg because America printed more dollars than the gold it possessed. In 2025, China fears America will attempt to anchor the Bitcoin peg before anyone else. History doesn't repeat, but it rhymes, and sometimes it roars. Outro of Part 1. The door opens. If Trump's executive order was the spark, China's response would be the wildfire. In the next chapter, we will uncover how China is moving, not reactively, but strategically, to seize a portion of Bitcoin's fixed supply before the United States can corner it. Their methods span mining, reserves, diplomacy, and digital currency engineering. A multi-front response that reveals one truth: the currency war has already begun, and the world has barely noticed. When Beijing's 7 most powerful men left that emergency meeting, they didn't walk out with a press statement. They walked out with a plan that would unfold in silence, in remote provinces, in power plants, in state-owned enterprises, far from the eyes of Western journalists, and far louder than any speech at the United Nations. Because China's first front in this currency war is one it knows intimately: Bitcoin mining. The ban that wasn't a ban. Publicly, the story is simple. In 2021, China banned Bitcoin mining. The headlines were decisive. China cracks down on crypto. China wipes out 75% of global hash rate. Rigs were turned off. Containers were packed up. Miners fled to Kazakhstan, the United States, Russia, and other havens. China's share of global Bitcoin hash rate appeared to collapse from around 75% to near zero in just a few months. To the outside world, it looked like China had walked away from the game. But China rarely leaves a table without flipping it first. The official justification for the ban was environmental: energy consumption, carbon neutrality, green targets, image management. The unofficial reason was control. Private, independent miners were operating at a scale that made Beijing uncomfortable. They were drawing vast amounts of power, building networks, and earning a globally liquid asset that the state did not fully supervise. In an authoritarian system, that is not just an economic concern, it is a political risk. So the government did what it does best. It cleared the board. The public loud mining operations were crushed. Permits revoked. Facilities raided. Hash rate went offline. But the story didn't end there, because some mining never stopped. The shadow hash rate. While retail miners evacuated, state-linked entities kept the machines humming. State-owned power utilities, military-affiliated tech contractors, infrastructure companies with direct party supervision. These actors quietly maintained mining facilities in regions like Inner Mongolia, Xinjiang, and parts of Sichuan, especially during the rainy season when hydroelectric power runs in surplus. The hash rate they produced was never labeled China in public charts. It was routed through VPNs, foreign registered pools, and obfuscated infrastructure. To the blockchain, it was just more hash from somewhere. To Beijing, it was the beginning of a state Bitcoin reserve. Estimates vary, but informed observers have long suspected that since the 2021 ban, China's shadow operations may have produced between 50,000 and 150,000 Bitcoin, quietly custodied in wallets connected not to random individuals, but to the People's Liberation Army's Strategic Support Force, the branch responsible for cyber operations, information warfare, and now, digital monetary assets. In other words, China treated Bitcoin mining the way other nations treat uranium enrichment, not for the public, for the state. Trump's 2025 executive order didn't start that strategy. It accelerated it. The switch flips back on. Within 1 week of Trump's order, subtle but critical changes began rippling through Chinese bureaucracy. There was no public reversal of the mining ban, no triumphant announcement of China returns to Bitcoin. Instead, instructions flowed quietly. Provincial officials in Inner Mongolia, Xinjiang, and Qinghai regions received internal directives. State-owned grid operators were told they could allocate surplus capacity to approved data processing facilities, a euphemism everyone understood. Government-favored firms were informed that Bitcoin mining, under the right guidance, would no longer be treated as a crime, but as a strategic contribution. China was doing what America rarely does, weaponizing its industrial base in coordination with its monetary strategy. Where America would rely on market incentives, subsidies, and lobbying, China would deploy something far more blunt. Top-down instruction, cheap or effectively free electricity, and regulatory immunity. And it possessed a resource unmatched by any other country: energy, the power of wasted electricity. China generates more electricity than any nation in human history, roughly 28,000 terawatt-hours per year, more than the United States and India combined. Not all of that power is efficiently used. In remote areas, coal plants and hydro dams often produce more electricity than nearby cities and industries can consume. Transmission over long distances is costly and lossy, so mountains of potential energy simply go to waste. But Bitcoin doesn't care about geography or distance. It doesn't need to be near cities or consumers. It only needs electricity, hardware, and internet connection. China realized it could transform stranded energy into sovereign digital reserves. What used to be wasted megawatts in remote areas could become Bitcoin, an asset that moves at light speed across borders, cannot be inflated, and is rapidly becoming a strategic reserve for nations. So Beijing began quietly directing that surplus into mining farms, massive facilities in Xinjiang and Inner Mongolia, seasonal operations in Sichuan leveraging surplus hydropower during rainy months, and new builds near coal and hydro installations where no one is watching with a camera. No retail competition, no regulatory bottlenecks, just pure state-driven accumulation. Their target? Regain 20 to 30% of the global Bitcoin hash rate by the end of 2026. At that level, China would be mining around 140 Bitcoin per day, 51,000 Bitcoin per year. Over 3 years, that could mean an additional 150,000 Bitcoin flowing steadily into state influence, on top of their pre-existing secret reserves. By 2028, China's total controlled Bitcoin, between historical mining, new mining, and shadow reserves, could reach 250 to 300,000 coins. That's not enough to match America's 1 million Bitcoin target, but it's more than enough to guarantee one thing: no American monopoly over Bitcoin. China doesn't need to win outright. They only need to make sure no one else can win alone. The new arms race. Hash rate as strategic capability. Think about how the Cold War measured strength in ICBMs, warheads, and delivery systems. This currency war measures strength in hash rate share, on-chain reserves, and energy that can be converted into digital scarcity. If America accumulates Bitcoin by purchase and seizure, China accumulates it by manufacture, by literally minting new coins using electricity as input. And this matters for 3 reasons.
1. Cost basis. China's mining operations, backed by state energy and industrial policy, effectively acquire Bitcoin at or near production cost, often far below market prices. This gives them resilience in bear markets and leverage in negotiations. 2. Plausible deniability. Because so much of this hash is routed through foreign pools and intermediaries, China can participate heavily in securing the Bitcoin network without officially admitting its scale of involvement. 3. Strategic optionality.
With large on-chain reserves sourced from mining, China can later back its digital yuan, contribute to a BRICS Bitcoin reserve, or quietly deploy Bitcoin as collateral in geopolitical deal-making. Mining is not just an industrial activity for them. It is a sovereign capability, a digital version of resource extraction. And unlike oil or copper, you can move this resource anywhere in the world in minutes. Set up for the next front. But mining is only front one. Power can give you a continuous trickle of Bitcoin. But if you want serious reserves, if you want to challenge America's ambition, you also need to buy. And that's where China's second front appears. Open market accumulation. Quiet, offshore, structurally deniable. While retail traders stare at charts, sovereign entities are already carving up the fixed 21 million supply behind closed doors. In the next part, we'll follow the money. How China is redeploying its $3.2 trillion in foreign exchange reserves. How it uses OTC desks, shell companies, and offshore entities to vacuum up Bitcoin without spiking the public price too fast. And how those purchases fuse with mining to push China toward 500,000 Bitcoin by 2028. As this unfolds, the question isn't just, who will own the most Bitcoin? The real question is, who will shake the rules of a world where Bitcoin is at the center? Because if mining is the engine, reserves are the steering wheel, and China is now reaching for both. Mining gives China a steady faucet, a slow, methodical drip of new Bitcoin created out of raw energy. But when a superpower believes it's entering a monetary arms race, a faucet is not enough. To compete with the United States aiming for 1 million Bitcoin, China must open a second front, one far less visible, far more surgical, and infinitely more revealing of the way powerful nations operate behind closed doors. This second front is open market acquisition. Not retail buying, not exchange speculation, not the frenetic trading of the public. These are deep pools, off-exchange transactions, synchronized through sovereign intermediaries, the back channels where states accumulate assets without shouting to the world, "We're buying." Because prices move when the crowd sees footprints. China cannot afford footprints. The mountain of reserves no one talks about. China holds $3.2 trillion in foreign exchange reserves, the largest pile of liquid wealth ever assembled by a modern government. Most of it sits in U.S. Treasury bonds, dollar deposits, euro and yen reserves, and other fiat assets tied to Western institutions. For years, China has been trying to diversify out of this dependency. Treasury holdings have quietly fallen from $1.3 trillion in 2013 to around $730 billion today. China has poured billions into gold, accumulating over 1,000 tons in just the last 3 years. Shadow reserves, held by state-owned banks and military entities, are estimated at 6,000 plus tons of gold. Gold is safe, but heavy, slow to move, hard to weaponize in a digital world. Bitcoin is the opposite, a globally recognized reserve asset that moves at light speed. Trump's Bitcoin reserve order effectively told Beijing, if you don't act now, America will own the new global reserve asset before you do. And China acted. The offshore buying machine. China cannot buy Bitcoin directly through its central bank. Doing so would require rewriting reserve asset guidelines and openly legitimizing Bitcoin, something Beijing is not yet willing to do. So, they do what great powers always do when the official route is inconvenient. They use proxies. Chinese purchases flow through OTC desks in Singapore, brokerages in Hong Kong, Swiss intermediaries familiar with state finance, sovereign wealth fund subsidiaries, shell companies registered in the UAE, Cayman Islands, and Luxembourg. These entities do not wear the Chinese flag. They wear masks. But masks do not hide intent, only identity. These channels allowed China to acquire Bitcoin without pushing prices violently upward. OTC desks specialize in absorbing large buy orders quietly, matched through fragmented liquidity sources. Since late January 2025, intelligence flows suggest China has already accumulated between 50,000 and 80,000 Bitcoin, mostly at prices between $90,000 and $100,000. On paper, that's only $5 to $8 billion, a rounding error within $3.2 trillion of reserves. But in Bitcoin terms, it is monumental. It positions China as one of the largest silent accumulators on Earth. And it's only the beginning. Sources indicate that Beijing has authorized up to $30 billion over the next 3 years for Bitcoin acquisition. That could translate into 250,000 to 300,000 Bitcoin depending on price volatility. Combined with mining, China could reach 500,000 Bitcoin under direct or indirect state influence by 2028. That is half of America's target, and more than enough to give China veto power over any monetary architecture built around Bitcoin. They don't need dominance. They need relevance. And 500,000 Bitcoin is relevance incarnate. Why OTC, not exchanges? When nation-states buy assets, they follow different rules than retail traders. Retail buys on Coinbase. States buy through channels you'll never see on a price chart. The reasons are simple. 1. Avoid moving the market. If China bought on open exchanges, prices would explode instantly. Liquidity would evaporate and every hedge fund on Earth would front-run the trades. OTC channels allow accumulation without leaving a visible footprint. 2. Maintain strategic secrecy.
3. Plausible deniability. If challenged, politically, diplomatically, or economically, China can say, "We're not buying Bitcoin. Private entities might be buying. We cannot regulate offshore intermediaries." Everyone knows the truth, but truth is irrelevant when deniability is an option. 4. Avoid internal political optics. China still bans mainstream crypto speculation domestically. If the public learned the government was buying what citizens are prohibited from owning, it would raise uncomfortable questions. So China buys in the shadows. The people don't need to know. The geopolitical purpose of Bitcoin reserves. China's Bitcoin accumulation is not speculative. It is strategic. Beijing sees Bitcoin through 4 lenses. 1. Hedge against dollar dominance. If the U.S. continues weaponizing dollar infrastructure, Bitcoin offers a parallel store of value immune to American control. 2. Collateral for a BRICS financial system. In a BRICS currency or settlement network, Bitcoin functions as neutral backing, a 21st century analog to gold reserves. 3. Support for the digital yuan. If China backs its ECNY with partial Bitcoin reserves, it instantly increases global trust, especially among countries tired of U.S. sanctions. 4. Insurance for systemic crisis. If the dollar undergoes structural stress, inflation, treasury instability, loss of confidence, Bitcoin becomes geopolitical life insurance.
not for individuals, for nations. The three-layer accumulation strategy. By 2026, China's approach crystallizes. Layer 1, mining, steady inflow, low cost, sovereign-controlled, politically untouchable. Layer 2, OTC purchases, bulk, discrete, non-market moving. Layer 3, BRICS alignment, amplifies China's influence by expanding its monetary coalition. China doesn't want all the Bitcoin. It wants enough. Enough to guarantee its seat in the new global monetary order, enough to prevent American monopoly, enough to ensure that the future of money is not unipolar. The transition to Front 3, the digital yuan, reborn. But mining and accumulation are only the beginning. China's greatest weapon is not energy or secrecy. It is architecture. China builds systems, lifelong systems, centuries-long systems. And behind closed doors, the People's Bank of China is preparing a redesign of the digital yuan, one that merges China's authoritarian fintech infrastructure with Bitcoin-backed credibility, a hybrid that no Western economist predicted. In the next chapter, we will explore how China intends to weaponize its CBDC, why Bitcoin backing changes everything, and how this move threatens the dollar more profoundly than any mining facility ever could. Because China isn't just buying Bitcoin, they're building a system around it. And systems, not coins, win wars. If Bitcoin mining is China's engine and OTC accumulation is its fuel, then the digital yuan, the ECNY, is China's vehicle for reshaping the future of money. It is the tool Beijing has spent nearly a decade refining, a monetary technology built for control, surveillance, and real-time programmability. And now, in the wake of Trump's executive order, China is preparing to give this tool something it has always lacked: credibility. Not propaganda credibility, not diplomatic credibility, but monetary credibility, the kind backed by scarce, globally recognized, neutral collateral: Bitcoin. The problem with the original digital yuan. China began developing the ECNY in 2014, long before most nations even considered CBDCs. By 2025, it had 260 million users, over $100 billion in pilot transactions, integration with retail, public transport, and government programs, and a sweeping technological infrastructure reflective of China's scale. But despite its size, the world refused to adopt it. The issue wasn't technical. China's digital yuan works flawlessly. The issue was trust. Because the digital yuan is fully controlled by the Communist Party, fully surveilled, subject to immediate freezing, programmable for compliance, devaluable by decree, and trackable from wallet to wallet forever. For foreign nations, especially those with tense relationships with Beijing, using the ECNY felt like walking into a monetary cage where China held the key. So international adoption sat near zero. Even Russia hesitated, even Iran resisted. Even Africa, where Chinese infrastructure investment is deep, remained cautious. China needed a way to transform the ECNY from surveillance money to strategic money. And then Trump's executive order provided the opening. The new strategy: Bitcoin-backed digital yuan. China's central bank is now exploring what a decade ago would have been unthinkable: a Bitcoin-backed digital yuan. Not fully backed. China wants control, but partially backed, strategically backed, symbolically backed. The messaging is subtle but unmistakable. The digital yuan will be redeemable for Bitcoin at official exchange rates. This is not a gold standard. It is something more adaptive, more modern, a Bitcoin guarantee, a promise that ECNY is not just a political instrument, but a monetary instrument, anchored to a neutral, globally scarce asset. Instantly, this reframes the digital yuan for international partners. Instead of relying purely on China's credibility, it now relies on Bitcoin's credibility, a credibility China cannot manipulate. Instead of being purely fiat, it becomes part hard money. Instead of being a closed system, it becomes a bridge between Chinese economic influence and the global digital monetary network. To nations skeptical of the America, this is irresistible, because the dollar today is backed by nothing. Not gold, not commodities, not Bitcoin, not even fiscal restraint. It is backed only by US military force, the inertia of history, and the dominance of legacy institutions. China knows this. China also knows that dozens of nations resent being trapped in that system. By offering a Bitcoin-backed digital yuan, Beijing gives them an exit ramp. Not a perfect one, not a clean one, but an alternative. And in geopolitics, the existence of an alternative is itself a revolution. Who adopts first? Certain countries will accept the ECNY with Bitcoin backing almost immediately. Russia, seeking to evade Western sanctions. Iran, eager for financial independence. Venezuela, locked out of the dollar system. Pakistan, economically reliant on China. Africa, where Chinese infrastructure and trade dominate. Southeast Asia, where China's influence is expanding rapidly. For these nations, a Bitcoin-backed ECNY reduces dependence on the dollar, creates an alternative to fragile local currencies, provides access to global trade without US oversight, and offers a store of value stronger than their national fiat. Each country that adopts the ECNY for trade represents a leak in the dollar dam. Leaks that become gaps, gaps that become fractures, fractures that become collapse. Not overnight, not in a single crisis, but gradually, then suddenly, the way all monetary transitions unfold. The economic mechanism that changes everything. Here's the key insight. The digital yuan doesn't need to replace the dollar to win. It only needs to erode the dollar's exclusivity. Every time oil is purchased in ECNY instead of USD, every time a BRICS nation settles trade through a Bitcoin-backed digital system, every time a central bank adds ECNY to its reserves, the dollar loses a tiny fragment of its monopoly. This is China's entire strategy. Not overthrow, erode. The British pound didn't collapse in 1 year. It slowly declined for decades as the dollar grew stronger. Now the dollar faces the same multi-decade erosion, and Bitcoin is the neutral anchor facilitating the shift. China is not trying to dominate. It is trying to equalize. A multipolar system benefits China more than any unipolar system dominated by the West. The digital yuan as a weapon. China understands something most Western analysts refuse to see. Money is not just a medium of exchange. It is a weapon, a surveillance tool,